There's some big changes coming with corporate taxes, and again, this is all starting in 2018, moving forward. So, major item that got most of the headlines was the corporate tax rate. All right, the corporate income tax rate. This is for C corporations. These are the type of corporations, mostly big companies, but some smaller companies as well, that these companies pay tax directly from corporate income. All right, so the rates in the past, the old law was they were graduated up to 35%, and the new law, you got a flat 21%. So that's a really nice reduction and a really nice feature. Also, the alternative minimum tax, AMT, is something that as accountants we actually hate to have to deal with, but it's a reality, and it still exists in individuals, but at least for corporate taxes now that's gone. What that is basically an entirely separate tax calculation you have to do using different types of deductions, and certain things that are allowed for regular tax are not allowed for AMT. So we no longer have to worry about that for corporate tax, for corporate income tax. That's good. Unfortunately, it still exists in the individual realm. And this, as you see at the bottom, that is a permanent change. Unless Congress acts again, this will not change. This doesn't expire in 2026, like the other items. All right, here's one I want to spend a little bit of time on, this new pass-through deduction. So we talked briefly about the corporate tax rates for C corporations. Congress said, okay, if we're going to help out C corporations, then we need to do something for other types of corporations, pass-through type entities, which is really what probably a lot of you in here that are business owners are probably using a pass-through entity. Most what we call Main Street, since we're on Main Street, let's call them Main Street companies, are typically organized as pass-throughs versus larger corporations tend to be the C Corps. This is for mostly smaller companies. So in the past, didn't exist, no deduction. Now, under the new law, you've got a 20% deduction. It's eligible, the eligible entities are S corporations, partnerships, and sole proprietorships. All right, there's a lot of rules and regulations surrounding this, but at its basic level, the qualified business income from a trade or business means you're actually operating a business. You get a 20% deduction straight off the top. It's pretty simple. So where the complexity comes in, though, is when there's some limitations on this based on your income. All right, so I'll talk about that in a minute. And one thing to note is this is not, in no case is there anything, is this eligible, or any kind of wages that are being paid to you are never eligible for this deduction. All right, so that's never a situation where you can take this. It's only, excuse me, it's only what we call pass-through income, mainly what you get on a K-1 or on a Schedule C.
Do you have the income threshold?
Yes, sir, I'm going to talk about, I'll talk about that in just a second. Yes, sir. Next slide, here you go. All right, so I said it was simple, but that's only if your income, if you're single, is below $157,500, and if you're married, $315,000. If you're below that, pretty straightforward. And if you're above that, it gets more complicated. So let's talk about some of the complexities here. All right, if you are over these income limits, and these income limits apply to your entire tax group. Like if you're married and filing joint, it's both spouses' income. It's everything. So it's all your income, all your wages, all your business income. And you add them all up, and if it's over these limits, then these new rules apply. All right, so if you're over these limits, the first limit, or the first exclusion is your business, your qualified business income cannot be from a specified service, trade, or business. All right, and you can see here the list. It catches a bunch of us in this room: law, medicine, accounting, consulting, investment services. For some reason, they carved out a specific exception for architecture and engineering. I'm not sure how they did that. Maybe good lobbyists or something, but they somehow carved that out as an exception. So they must have spent some money on the lobbyists. But anyways, if you're in one of those business and you're in business lines, industries, and your income is above that amount, sorry, you don't get to take this deduction on your flow-through income. The second item is, let's say, okay, you got the income over the amount. You're not in one of those trade or businesses. You're in something else like manufacturing or hospitality or something like that. You're only allowed to take the deduction if your business has W-2 wages and or tangible property Now, if you think about the types of businesses that are not on that list, again, think about a manufacturing facility. You're going to have employees, and you're going to have a lot of property that's on your books, because what you got to have machinery and equipment and people to run those machines and equipment if you're going to manufacture something. So most likely, I think this is not going to affect too many folks, but it is still a calculation that needs to be done. And I think we've got to look at it and plan for it. Now, there is a phase-out range once you get above these income amounts, and it's $50,000 for single and $100,000 for married. So really, the actual phase-out is what 2075 and 415 is the true phase-out, or the true zero amounts. But it does phase out as your income gets above those amounts. Now, this is one area we do have some new updates. So what I previously told you was all in the 2017 tax reform bill. This new item, or these new updates, came about in August of 2018. So what is a specified service trade or business? We had the list that we looked at that had things like law and accounting and investments and things like that, medicine, things like that. But what does that actually mean? How do you actually, in detail, how do you actually define those businesses? And what about kind of fringe businesses that are kind of in that industry but not necessarily in that industry? Well, this new law basically clarified some of that. So one of the items, and I've got an article that goes into a lot more detail about this, that if you'd like a copy, and we can send that out to everybody, it really lists out and dives deep into what's included here. But one of the examples they gave is, for instance, on that list, you saw medicine. All right, so for instance, if you're operating a medical practice, and say it's a GP practice, something like that, family practice, that kind of thing, you're not going to qualify. But what does qualify is things that you might consider healthcare, like running a physical therapy type of a practice, or a health club or a spa, things like that. Those types of companies probably will qualify, most likely. And there's some rules and regulations that talk specifically about that and say, things like medical testing or medical research, that qualifies. But you kind of say, well, that's not really a medical practice, but they just wanted to clarify it in the rules to make sure you knew that's going to qualify and it's not excluded just because it's related to medicine. Also, the second item there, you see providing services to a specified service, trade, or business does not automatically disqualify your business. So let's say you own rental property, because rental activities are likely going to be qualified for this. It looks, from what we've seen, it looks like they are qualified for this deduction. Let's say you're renting property to a medical practice, or to a law practice, or to an accounting practice. That does not disqualify you just because you're doing business with a disqualified type of business, all right? Or if you're providing other types of services to someone who's disqualified. One positive thing that we saw through these new updates is ancillary consulting. So for instance, something related to consulting that has to do with equipment manufacturing or equipment installation or something like that. If it's kind of an ancillary thing where we're installing equipment or we're doing something physical that involves goods or merchandise, but we're providing a little bit of consulting on the side, trying to help you out, provide good customer service, that's not going to eliminate you from being able to take this deduction. So that's a good feature. I think that's a good thing. And the only caveat to that is generally you're only going to allow that, or not going to be disqualified, as long as you don't have a separate line item on your invoice for the consulting services. All right. Now, I don't think that is talking about labor. I think that's specifically saying, you're consulting. You're actually doing consulting, and it's a specific, maybe an hourly type thing or something like that. So as long as it's not done that way and it's just kind of lumped in and with the price of the equipment or the installation fee, I think you're going to be okay. Hybrid businesses, there's an exception that was put into the regulations. So if you have a business that is clearly doing both a not allowed business and an allowed business, well, if you meet these exceptions, under 25 million of revenue, if the not allowed portion is under 10% of your gross receipts, you're good. It's kind of a safe harbor. De minimis rule. If you're over 25 million, as long as no more than 5% of your gross receipts is the disallowed activity, then you're in good shape too. And you can take the deduction on the whole amount. Now, very interesting development, I thought. One of the most interesting things I read in this new regulation is that there's a phrase at the end of the rule that says, any business, let me see if I had it on here or not. I don't think I did. Okay. Well, it's talking about you're disqualified if you're one of those industries or if the reputation or skill of one or more of your employees is the primary product or the primary reason that people do business with you. Okay, and so when we saw that initially, a lot of commentators were thinking that's going to disqualify a lot of Main Street type businesses. You know, think about actually an example they gave in the regulations was a bicycle shop, maybe a high-end bicycle shop where you've got someone who's been in the business for 30 years, they know everything there is to know about bicycles, and you go to that person, they are able to fit you with the perfect bicycle and the perfect accessories, and they're providing a lot of consulting and a lot of advice to you. Well, you've gone to that person because you know their reputation in the community is really good, and you know that they will do a good job for you and provide you the best service and the best quality of products. Well, the IRS says that's okay. That actually does not disqualify that bike shop from taking the pass-through deduction, which I thought was really interesting. What they said does disqualify you in terms of reputation and skill is primarily they focused on celebrities. So I thought that was really an interesting thing. It's very, I think, taxpayer friendly, at least for us common folks who are not celebrities, that basically if you're not, unless you're getting paid to endorse a product or paid to appear at a grand opening or something like that, or whatever it is you're doing, or you're in a commercial or something like that, unless you're doing one of those things, then you're okay in terms of that one test. Now, it doesn't mean you won't be disqualified for other reasons, but a really, again, a good example that they brought up in the regulations is think about a celebrity chef, you know, someone like a Bobby Flay or someone like that. There's multiple tiers or multiple, you know, sections of their business. They actually, a lot of those guys run restaurants, you know, they have usually very successful restaurants, maybe in big cities and very high rent districts because they know they can generate a lot of volume. So they've got very profitable restaurants, but then they also, of course, they're celebrities. They may have a line of cookware, they may have a line of consulting services, they may appear to, you know, I think Alton Brown does all the kind of commercials for grape juice and all these kind of things. Those kind of things, of course, are not going to qualify. But just because you're doing those things, it doesn't disqualify the restaurant side and the actual business that you're running, or if that person happens to own, you know, a piece of a manufacturing company or some other type of company that does qualify. So just because you're a celebrity doesn't disqualify your other lines of businesses. So I thought it was good too. So again, very taxpayer friendly, and it really makes you think you need to, if you're working with someone who's a celebrity, or you have a client or someone as a tax preparer, if we have a client who's a celebrity, we need to look at that and make sure those lines of businesses are separated out. All right, a couple other things the updates did. It clarified the wage calculations, as I mentioned before, that if you're above those income thresholds, you do have to do some wage calculations to determine how much deduction you can get. It kind of clarified that, and that's very technical. I won't go into that today. But another interesting development was that immediately when we saw this deduction was available, we started thinking about a lot of our clients that have multiple pass-through entities. So if you've got one business you're running, okay, it's nice and clean. You got income, you take the deduction if you're eligible. But what if you've got one business that makes money and one business that loses money? And maybe the business that makes money doesn't really have a lot of wages and property, but the business that loses money does have all the wages and property that would make you eligible for the deduction. Well, these regulations clarified that you will be able to kind of consolidate those things and aggregate those things and put all that together. Again, a lot more technical than I need to go into today, but just to know that is available. And if you've got multiple pass-through entities, there is some leeway and some flexibility to be able to combine those items and combine those elements. All right, bonus depreciation. We've got, basically with bonus depreciation, this is something that, in general, depreciation of property, you probably, most of you probably understand what that is, but if you buy a big piece of property, either real estate or equipment or vehicles, things like that, you generally cannot deduct all of it right away. You've got to take a little piece over time, all right? So that's the general concept of depreciation. What bonus depreciation basically says is you're allowed to expense a good chunk, either in the old rule, you see that the old law was 50%, the new law now is 100%. Now, the old law, we were already in a phase-out range or phase-out time frame for bonus depreciation. This is something that already existed. It was being phased out. The tax reform law basically extended it for several more years through the year 2028 and allowed it to go from 50% up to 100%. So that's a big deal. When you've got some equipment that you're trying to deduct or you're purchasing, being able to deduct it immediately, the 100% of it is a really nice feature. It can tremendously help with cash flow. If you're putting a lot of cash into something, you're not really financing it or you're financing a small portion of it, that cash is gone. You want that deduction now. You don't want that deduction 10 years from now. You want it now because that cash is gone. So this really helps out from that perspective. Another big change with this is in the past, only new items were allowed for bonus depreciation. So it had to be brand new. You couldn't buy a used piece of equipment. Now, you can have new and used property. So you can take this on a used piece of equipment or a used item. So that's a new thing. In general, in the past, there were personal property and limited types of real estate improvements, not necessarily the building, but maybe the improvements were allowed. Currently, the personal property is still allowed for this, but qualified improvements of real estate, you may have heard about this drafting error that they say was in the law, that for some reason they kind of left this out, that improvements to properties like interior improvements, unfortunately are not captured under this rule, at least for now. We're thinking at some point we might get a correction on that, but as of right now, it is not allowed. So unfortunately, if you're doing a major renovation to a property like a rental or a business property or something like that, unfortunately, it's going to be depreciated over many years. But sit tight on that. Hopefully, we'll get some changes soon. Another, sure.
That would apply both to subchapter S and C corp.
Yes, any type of business is eligible. The question was, what is it eligible for? Are S corps and C corps eligible to take bonus depreciation? Yes, that's correct. Any type of business. Cost recovery under Section 179. Excuse me. This is another law that's been around for a while, and basically was expanded by the tax reform rules. All right, so Section 179 is slightly different from bonus depreciation in that basically there's just a dollar limitation on what you can take in terms of immediate expensing. So it's very similar to where you immediately expense the price of equipment, various types of property that you purchase, but instead of just being a percentage of the basis, you can take any dollar amount up to the limits. All right, the old limits were, well, let me show you, I've got a chart here. Let me flip to that real quick. The old limits, starting in going through 2017, the maximum deduction was $510,000. All right, and now 2018 and forward, and I don't know if we have the 2019 inflation adjustment amount yet. I'm sure it's out there somewhere, but I don't have it in this presentation. It's $1 million. So it effectively doubled that amount that you can take. All right, now, the only caveat to this, the only rule related to this is generally going to be for your smaller businesses, because once you have more than $2 million in the past, or this year for $2.5 million of property that is being put into service, once you get above that amount, you're no longer eligible for this deduction. All right?
You said that's based on taxable income?
No, that's the property that you put into service.
So if I put in over $2 million and $30,000, then I can't deduct anything?
You cannot take Section 179. Yes, so the question is if you put into service property over this for 2019, it's going to be $2.5 million inflation adjusted. If you put into service that much property or more, then you're not eligible for the Section 179. I'm not going to repeat that. But remember, you've got the bonus depreciation. There's no limitation on the bonus depreciation, so you'll be able to take that. Mr. Kroger, I know John's going to take good care of you on that, so he'll make sure you get your full deduction on that. But under Section 179, again, this is something that's, I think, a very positive thing, because again, kind of the small business community, unless you're running a major manufacturing type entity, you're probably not going to put more than $2.5 million of property into service with most small businesses. Now, there are exceptions. So this is a very good thing. Just real quick, going back here, again, the old law, under the old law, you had some real estate property was allowed, but nothing for rentals, and the deduction was limited to your taxable income. So in other words, you can't take Section 179 in excess of the income that you have. Yes, sir?
Have y'all heard any rumblings of what South Carolina's going to do as far as following any of this?
I know they did pass the conformity law. The question was, what is South Carolina going to do with this? South Carolina does allow the Section 179, and the limits are the same, right, John? Yeah, there's no change in the limits. I think that might have been what your question was. The limits for federal and South Carolina are the same, but South Carolina does not allow bonus depreciation. So that's why we typically say, if you are eligible for Section 179, that generally is preferable because you don't have to adjust it out for South Carolina purposes. So that's a good feature. Also, something new this year is for Section 179, we are allowed to take some new real estate items for Section 179. The improvements, I think, in the past typically had been, but also there's interior improvements, but there's a new allowance for exterior improvements. And the items here, you can see your roofs, HVAC, fire protection, alarm and security systems. That's all brand new, and that was never eligible for Section 179 in the past. So I think that's a new feature that a lot of folks will be able to take advantage of. All right, there's a chart, and again, you'll all get a copy of this. You'll have that. All right, for the bankers in the room, interest expense limitation. This might affect some of the things that you do, but also for the business owners. In the old law said that basically if you had interest related to your business, you're financing something, you're financing property, you're financing operations, whatever, that interest was deductible as long as it was business related. Now, and you'll see some exceptions to this, there is a limitation for interest paid by businesses, and that limitation is generally speaking, with some exceptions, 30% of your adjusted taxable income. Now you see I've got these two items highlighted here. That means I'm going to define them in the next slide or in a later slide. All right, so the deduction for business interest is limited to the sum of your business interest income and 30% of your adjusted taxable income. Now, there's also an exception for floor plan. If you've got any auto dealers in the room, or if you know of any, floor plan financing is fully deductible, the interest. So they did carve that exception out. If you have disallowed interest because it's over the limit, it's carried forward. All right, so let's define some terms here. Business interest is defined as interest paid or accrued on indebtedness properly allocable to a trade or business. It does not include investment interest. All right, so we're talking about, again, financing of equipment, financing of operations, that kind of thing. Here's how to calculate your adjusted taxable income. So here's the computation. You've got any item with that, basically you calculate your taxable income without regard to these items right here. Anything that's not a trade or business, business interest or business income, net operating losses, and just for 2018 through 2021, to kind of help ease this transition, you don't have to factor in depreciation and amortization. All right, so what that does is it bumps up the amount of income that you can apply that 30% threshold to. All right, so that does help for the next, so last year, this year, 2 more years in the future, you'll have that transition rule that you can apply, and basically helps ease that. But after 2021, you will have to put that depreciation amount in there. That's a big factor. So think about the interplay between this rule right here, and what we were just talking about, where you want to just knock out that depreciation as fast as possible on your equipment. That's a great thing because it's a big deduction. But what happens when you do that after 2021, that's going to possibly limit the interest deduction that you can get when you're financing your business. So again, it's just something that has to be planned for. You have to think about it.
How does it affect the developers who have a year and a half to 2 years sometime, but nothing but interest going out with no income? Do they have to carry that forward, or is there some allowable?
Question is, how does that affect developers who often have to carry interest over a couple of years? Well, there are certain rules where you can actually apply that interest and elect to have it included in the basis of the property. So there's types of elections you can make that could alleviate that. And but
Would have some relief.
there is some relief, yeah, potentially. Carrying costs can be elected, and you can, instead of deducting them as interest, you can deduct it as a basis of the property that they're selling, the development property. So there are ways around that. All right, now the one nice thing about this is if your gross income or your gross receipts are under $25 million, this doesn't apply. So that's going to relieve a lot of small businesses out there. You know, I mean, not everybody, but there's a lot of businesses out there that we work with that are under 25 million. So I mean, I think that's a good thing to carve that exception out. Also, it does not apply to a rental property if it's a rental trade or business. If you're actually in the business of renting, this doesn't apply. So that's a good exception as well. The only caveat to that is if you elect out of these rules, you might not be able to take those nice, really quick depreciation adjustments or elections that we were talking about earlier. So there's kind of a trade-off there. So again, you might have to look at it and see which way is going to work better for you. All right, a couple of planning items real quick, and I want to get to the next section as quickly as we can so we can have some time for Q&A. But take advantage of the new depreciation and Section 179 rules. Of course, that's pretty straightforward. But as I mentioned before, I've got it right here. Be careful how that plays into the interest limitations after 2021. So just got to think about it. Also, the section, or sorry, I missed one. The cost segregation study. That's something that we've done a lot of these for clients in the past. And if you're in real estate and having exposure to real estate, you might have heard of this. Basically, what a cost segregation study does is takes all of the components of a building and breaks them down so that you can potentially take more advantage of the accelerated depreciation rules that we were talking about. So generally, commercial real estate depreciates at 39 years. That's a long time to depreciate a property. So if you do a cost segregation study, you could take a $10 million building and maybe a couple $1 million or even more than that could be broken down and it could be considered personal property. And personal property generally is depreciated over either 5 or 7 years, and it could be eligible for the bonus depreciation or maybe even some Section 179 depending on the size. So that's what a cost segregation study does. And these are very detailed studies. They're done by engineers and accountants that work together. And they typically are somewhat expensive, so it's something you really have to commit to. It could be several $1,000s depending on the size of the property. So it's something you want to look at. But we think that in a lot of cases with significant property holdings, it's a good positive step because not only does it give you some potential for accelerated depreciation, but also it really, honestly, it gets your property in the proper categories. Because cost segregation is not something that's necessarily a loophole or something. It's what the interpretation of the folks who are doing these is that you're getting those categories correct rather than doing them incorrectly versus having the entire property being considered commercial real estate. Under the laws and under the rules, you really should be breaking it down. So we think that cost segregation is more the rule than the exception. But anyways, it's not always cost effective to do them, but it is something to think about. If you've got significant real estate or if you're looking to purchase real estate, I would consider it. Oh, I thought we had a question, sorry. All right, the Section 199A pass-through deduction, of course, just start thinking about that. Start planning if you have multiple entities, start looking at how those are structured. And also, you might want to think about adjusting your wages. If you're an S corporation shareholder, there's the rule that says you have to have reasonable compensation if you're providing services to the company. But it might need to be adjusted slightly so that you can take more advantage of these the pass-through deduction. And then there are some new limitations on losses and how they can be deducted, so we need to be paying attention to that. I didn't really talk about that too much, but it is something to consider that there are some new limitations. The biggest one being that for net operating losses, you can no longer carry those back. So in the past, we were able to take a loss. Let's say you had a loss on your business. You could actually carry that backwards and maybe even get a refund of a prior year tax. You can't do that anymore. It can only be carried forward.